Hello and welcome. In this lesson, we are going to talk about discounted cash flow models. They are also called as DCF models. So, when you say discounted cash flow model, the obvious question is what do you mean by a discount or a discount rate? Or what does it mean by discounted cash flow model? Discounted cash flow model says that to get the stock price of the company, you will discount the future cash flows of the company to arrive at the intrinsic value of the company or fair value of the company. Now, what kind of cash flows this could be? So these cash flows could be dividends, these cash flows could be free cash. Now, given these could be the cash flows for company, how do their models look like? How do we really go about discounting these cash flows to arrive at fair value of stock? So let us have a look at them one by one. Before we look at the discounted cash flow models, let us first try to understand what is a discount rate. Now, discount rate is typically an expected rate of return that you expect on any kind of a security or any kind of investment opportunity that you are looking forward to invest into. So, expected rate of return is given by RFR plus beta into RM minus RFR. Now over here RFR is risk-free rate. By the way, there is nothing called as risk-free, but the closest match for risk-free or on which we will expect the least default are long-term government bond yields. So long-term government bond yields. So that is what is referred to as RFR. Beta of the stock is how the stock price returns move with respect to the index returns or the broader market returns. RM represents the returns of the broader market. So the estimate is considered on long term basis to the tune of 10 to 15 years. RFR is again the same RFR we referred earlier. RM minus RFR is referred to as risk premium. So that is how you will calculate expected rate of return. So this expected rate of return in case of equities is called as cost of equity. In case of debt is called as cost of debt. In case of firm it is called as weighted average cost of capital. So we have already seen how do you calculate returns on or expected returns on equity, which is KE is given by RFR plus beta into RM minus RFR. This equation is given by the famous capital asset pricing model. Now let us look at how do we calculate KD. KD is calculated by interest expenses divided by total borrowings of the company. Now let us look at how do we calculate weighted average cost of capital. So WACC is given by KE into E divided by debt plus equity plus KD into D divided by debt plus equity. Mostly this is taken as KD into 1 minus T because of the advantage of having debt on the balance sheet. Now debt and equity over here are considered at market value. Now in Indian context, debt is mostly not traded, so this value is considered as book value of debt. So that is how you will calculate weighted average cost of capital. This weighted average cost of capital is predominantly used to discount the free cash flows to firm of the company. Now let us look at how do we calculate the FCFE. FCFE is given by PAT plus depreciation minus capex minus delta working capital minus principal repayments plus new issue of debt. That is how you will calculate free cash flow to equity. Now let us look at how do you calculate free cash flow to firm. FCFF is given by, now it is at the firm level cash flow, so it begins with EBIT into 1 minus T, so it is essentially post tax EBIT plus depreciation minus capex, so rest of the things remain same, minus delta working capital. So that is how you will calculate free cash flow to firm. Now there are three models that prevail in computation of discounted cash flows in all these models. These three models are, the first model is the stable growth model, where the assumption is that the cash flows are growing at a stable growth rate, and this stable growth rate is considered as long-term growth rate in the economy. Now this growth rate is considered to be infinite growth rate, and it cannot be significantly higher than the economic growth rate. Reason being, if it becomes significantly higher than the economic growth rate over a period of time, because of compounding effect, the size of the company will be more than the economy size, which is logically wrong. That's why this GN has to be somewhere around the economic growth rate, and if you assume it to be significantly lower than the economic growth rate, then the company would cease to exist, which again goes against the assumption that company will continue to perpetually be there. So that is how the stable growth model looks like. The second level model came into existence because of the drawback in the first level model, which is that the model doesn't capture high growth companies. So the two-stage model talks about a high growth followed by a stable growth. So here you will discount this high growth phase, and it is followed by a stable growth phase. Now the value that you get over here is called as terminal value. Now this terminal value is given by cash flow 1. So if we assume that this is cash flow 0, so I would say the generic equation will be cash flow n plus 1 divided by KE minus GN. So this is called as terminal value because here we are going through the kind of growth rate which is stable, and it's kind of end of growth rate that the company is experiencing currently. That's why it is called as terminal value. Now in this case you are getting this terminal value at the 0th year. Now in this case you will get this terminal value on the nth year and will be given by cash flow n plus 1 divided by Ke minus Gn. So in this case, the earlier case, the equation becomes cash flow 1 divided by Ke minus Gn, given that we are getting this terminal value on the 0th year. Now after you get this terminal value on the 0th year, you need to discount this value further to 0th year to ensure that you are getting the value on the 0th time period. Now the drawback of this model is that there is sudden drop in growth. Now this sudden drop in growth normally is not seen, and that's why what we have is a three-stage model. So the three-stage model, we say that the company will first grow at high growth rate, then it will have stable growth rate, and then it will so it will first grow at high growth rate, then it will have transition phase, and then it will grow at stable growth phase. So this is GH and this is GN. and this phase between GH and GN, it is transition. Now this is mostly a linear transition that we are assuming over here. So that these are the three different models that prevail in DCF analysis. So if we are talking about the dividend discount model and we are talking about a one stage model, then this is what model we are talking about. Then in that case, and let us say we are talking about dividend discount model, then in that case the P0 or the fair value of the stock is given by DPS1 divided by in bracket KE minus GN. So that is the fair value of the stock. In two-stage model, you would see two-stage model is a high growth model followed by a stable growth model. So in this case, you will get, so this, let us say this is nth here, then we will say P0 is present value of high growth DPS plus present value of terminal value. Now this terminal value in this case will be given by DPS n plus 1 divided by in bracket KE minus GN. Similarly, you can think about how this three-stage models equation would look like. Now that is about different models and how this dividend discount model fits across these three models. Similarly, it goes for FCFE as well, that if we say in the one stage model, the model will look like P0 is equal to FCFE 1 divided by KE minus GN. Again, the discount rate for both FCFE and dividend continues to be KE. We recommend you using three-stage model for high growth companies so that you give proper justice to the computations of fair value of the company. That's about it for now regarding DCF, and we may have one more interaction on details of each of them at a later date. Thank you.